Shares of electronics retailer Best Buy are trading lower after its latest earnings release. The company cut its outlook as U.S. President Donald Trump's tariffs raised the cost of imported electronics. Let's bring in Stephen Zaccone, retail and hardlines analyst at Citi Research. He joins us now from New York City. Stephen, thanks a lot for joining us. I've read your note. You put a fair bit of emphasis on the miss on same-store sales at Best Buy, and you say this happens despite the fact that retail peers of Best Buy, other companies, have reported a lift in spending on electronics. Why don't we start there?
I think that's the real big focus today. Thanks again for having me on. We've heard about some strength in electronics once the tariff announcements went into effect, right? So I think it did raise expectations a little bit for a Best Buy, because this is an environment where you should be seeing that consumer come into stores and maybe do some panic buying before tariffs went into effect. I think that's really the big focus for this print, because you saw same-store sales kind of decline, right? Miss expectations. Expectations were probably in the more slightly positive comp camp. They did lower the year, but I think it really starts with just kind of missing sales expectations.
You say the company needs to invest, among other things, in competitive pricing. That sounds like taking steps to put more of its merchandise on sale. Do I interpret that correctly?
I think it is. I think what we've seen in the consumer electronics area has been a shift towards value, right? So we cover the warehouse clubs, and Costco and BJ's, they have an electronics business. Costco's much bigger. They've really been some share gainers in this consumer electronics and appliances market. We also cover Home Depot and Lowe's, and both Depot and Lowe's talked about appliances being a pretty good area despite big ticket challenges in housing. So, by contrast, like Best Buy still comping down high single digits in appliances, it's clearly a sign they're losing a bit of market share, right? And I think that becomes the problem for a Best Buy is, yes, you're the that last retailer standing thesis in consumer electronics, but it doesn't necessarily mean that's a reason for you to be a share gainer, right? Like, people have other options to purchase consumer electronics and appliances. And I think that's what's sort of playing out. So to your point of your question about competitive pricing, I think that matters. I think you've got to see some investment from a marketing perspective, from a store labor perspective, right? You and I want to go into Best Buy to have someone kind of direct us to what the right product to buy is, talk about different features across different brands. If you don't have that sort of customer service, people can kind of just shop online or shop elsewhere.
So you're all about market share in these results. You also say the company needs to invest or spend more on labor and marketing. So if you add all those up, or if you consider them all at the same time, lower prices for customers, more spend on labor, if I understand correctly, more spend on marketing. Those are all perhaps market share positive, but probably, at least in the near term, profit growth negative, correct?
You hit it right on the head. I think that becomes the challenge for Best Buy, right? Because we've been in this environment for the last couple of years where sales have been declining, right? You saw the big pop during the pandemic. Everyone needed to go out and buy PCs. And now we're in this environment where the consumer's coming back from replacement cycles, but they're more price driven, right? They're more value driven. So you're going to go to a place where you're going to get the best value for your dollar. That even could be a Walmart, right? Or a Costco. So for a Best Buy, it's like, you're not in an environment where you're kind of gaining share. So to do that, you've probably got to invest a bit. So that becomes this dilemma where you maybe see sales growth, but it doesn't really benefit the bottom line. So that's why we're not really recommending shares of Best Buy. We have a neutral on the stock. So I do think they're in a difficult spot from a overall strategy standpoint right now.
The company also said, and you took note of it in your report, that China now represents as at the most 35% of Best Buy's sourcing. In other words, it sources about 35% of its merchandise from China. Just a quarter prior, that number was 55%. So that's a big drawdown, it seems to me, in purchasing from China. How did the company accomplish that? And are there costs associated with doing so?
Yeah, I think it's working with their vendor partners, right? So, Best Buy only has direct imports of 2 to 3% of their purchase, so it's very small. So when you think about their key partners, it's the Apples, it's the Samsungs of the world, right? They've probably moved some of their production outside of that region. Best Buy also has some private label, right, where they can work with a vendor that's maybe based in Vietnam or Taiwan or in Mexico, and that's probably some of their own televisions and stuff that they have under their private label brand. So you have seen them kind of move quick. In terms of a cost, they've talked about the fact that they've had diversified manufacturing in the past. A lot of these retailers, made these efforts on the first wave of China tariffs, right, that Trump put into effect in 2018. So you've seen some diversification. I think, just given the fact that those China tariffs, when they first went on, were very high, it was a quick move to another region.
Stephen, thank you so much for your insight today. Stephen Zaccone is retail and hardlines analyst at Citi Research, has a neutral rating on shares of Best Buy. When we come back,